Assalamualaikum warahmatullahi taala wabarakatuh. We start our discussion with umur kitab Al-Fatihah. A'udzubillahi minasyaitonirrajim. Bismillahirrahmanirrahim. Alhamdulillahirabbil alamin. Arrahmanirrahim. Maliki yaumiddin. Iyyaka na'budu wa iyyaka nasta'in. Ihdinas siratal mustaqim. Siratal ladzina an'amta 'alaihim ghairil maghdubi 'alaihim waladdallin. Alhamdulillahirabbil alamin wassalatu wassalamu ala asyrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Allahumma aftah 'alaina hikmataka wa anshur 'alaina min khazaini rahmatika ya arhamar rahimin. Assalamualaikum. My group will discuss topic of cost of capital. So this is my group members, Nikmatullah, Tengku, Putra, Muhamad, Nafis, Abdul, Muqtasid and Abdul Qayyum. Okay, what is the cost of capital? Is the rate that must be earned by the firm at a given level of risk in order to satisfy its investors. Okay, cost of capital represent the overall cost of financing to the firm, which include the cost of debt and the cost of equity. So this is the importance of cost of capital. It is crucial for a firm. It's crucial means that it is important for a firm to determine its cost of capital. This is because the cost of capital links the firm's investment decision with its financing decision, which is related to the investors, to their financing decision for the investment to the company. So this is the chart, financing decision that might affect the cost of capital, and the cost of capital might affect the investment decision, and investment decision also might affect the financing decision. So means that all of these are related to each other. So understanding the concept of cost of capital. Okay, so I will explain to you the factors that affect the cost of capital. This is first, economic condition. Generally, economic condition, there is the state of the economy in a country or region. Economic condition can change over the time in line with the economic and business cycle. And then the second one, firms operating and financing decision, also one of the factors that might affect the cost of capital. And then business risk, whether it is by internal or external, which is it is directly or indirectly. So these barriers, these boundaries can arise unexpectedly, that can hinder the company's operation, especially on cost. So of course it will affect the cost of capital of the company. And then financial risk. So as you all know, finances allow a company to hire staff, to buy equipment, lease building, and more. So since so many aspects of a business rely on good financial standing, financial risk can be devastating to a company. So according to Business Link, debt is one example of financial risk. So when a company rake up large amount of debt, so it probably will affect the investors. So means that the investors, if the companies get a high level of debt, so the investors may feel uncertain about their return on investment, which is ROI. And then the last one is the size of financing. So this is the weighted average cost of capital. So the average of the firm's cost of fund from all investors, which includes the creditors and also the stockholders. Okay, this is the formula of the WACC, which is WACC equal to the cost of each source of financing, which we'll explain later, times with percentage of the financing provided by that source. Okay, so this I will explain to you how to calculate the WACC. There are 3 steps to compute the company's WACC, which is first calculate the cost of individual component of the firm's financing, which is cost of debt, preferred stock and common stock. So there are 3 of them, which is cost of debt, preferred stock and also common stock. And the second one is determine the percentage of debt, preferred stock and common stock. So we will explain to you, or we will discuss it very detailed later about how to calculate cost of debt, cost of preferred stock and also how to calculate the cost of common stock. And then the last step is calculate the firm's WACC by multiplying the cost of the individual financing resources by the percentage financing resources, which is this, by the percentage of financing.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Nikmatullah Ajwad bin Adnan. I will explain about the cost of financing. In cost of financing, there are 3 components. There is first is a cost of debt, second is cost of preferred stock, and lastly third is a cost of common stock. Okay, first I will explain about the cost of debt. Cost of debt is the rate that must be received by a company from an investment to achieve the required rate of a return for each creditor. The creditor here refer to long-term creditors. It is measured by the interest rate paid to the bondholder. Okay, how to compute the cost of debt? The computation of the cost of debt will be straightforward if the bond is sold and redeemed at its par value. In this case, the cost of debt to the nominal rate of interest or the compare rate. This is formula of cost of debt. Okay, for the I here is refer to the interest paid at time. P, principal repaid to bondholder on maturity. Okay, this here. Okay, for the K, bondholders require rate of return. For the P, price of bond. Okay, the second is cost of preferred stock. What is meaning of by cost of preferred stock? The rate of return must be earned on preferred stock holders' investment to satisfy their required rate of return. It is similar, so the cost of debt in which constant annual payment is made, in this case the annual dividend. Okay, however, preferred stock normally do not have maturity period. Okay, this is formula for the cost of preferred stock. PO, dividend divide required rate of return for preferred stock. PO, that means this is the simplify of the formula. D refer to the market value of preferred stock. PO refer to the market value of preferred stock. D for the annual dividends. For the K, required rate of return for preferred stock. Okay, from the above formula, the cost of preferred stock K is dividends divide market price. This is for the million for the K to find the KP. Right. Okay. The last one is cost of common stock. cost of common stocks, we can divide into two items. There is internal common equity, and the second is external common equity. For the internal common equity is the earnings available to common stockholder that can be retained in whole or in part within the company and used to finance future investment. For the external common equity is the new common stock may be issued by a firm to raise financing for its investment. Okay, for the cost of internal common equity consists of two alternative approach to measure common stockholder rate of return, which is dividend growth model and capital asset pricing model. For the dividend growth model, the value of common stock is equal to the present value of expected future dividend discounted at the stockholder required rate of return. So this is formula. Okay, D1 is to refer to dividend at the end of the first year. Okay, for the KE, required rate of return on equity. For the G is for the growth rate of dividend. This is G. Okay. For the capital asset pricing model (CAPM), rate of return common stock also can calculate using the capital asset pricing model. For the this is formula for KE. Okay, kita for KE, so refer to the this formula. KE refer to the required rate on common stock. For RF, risk-free rate of return. For the beta coefficient. For the RM, return on the market as measured by the stock market index. For the cost of external common equity involves the issuance of new common stock. Okay, the cost of issuing new common stock is similar to the cost of internal equity, except that a company has to incur flotation costs. Okay, this is formula. NPO means net profit per share received by the companies. So this is formula to find D1. Cool. That's all for me. And then our group, we explain more in detail about the cost of preferred stock and common stock we give to solve the problem in questions. So I hope you enjoy my video. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Tengku Putra. For the cost of capital. Okay, for my part, let us see the question and answer the question. For this question is Topal Loba Setian Berhad has the following capital structure, which is considered to be optimal. Type of security, as you can see, 11% bonds, which is in 20 million, 9% preferred stock for 15 million, and common stock for 65 million. Okay, the firm needs to raise 8 million to upgrade the company computerized system. The following financial instruments will be used to raise the capital. 11% bonds per par value at RM1000 will be issued at 1050. Flotation costs on issuance of these bonds are 3%. The bond will be redeemed at RM1100 after 10 years. 9% of preferred stock at par value of 100 will be issued at RM 95 ringgit. Flotation cost of 5% will be incurred. If necessary, new common stock will be issued. Flotation costs are expected to be 4%. The current market price of common stock is RM 7 ringgit per share. The dividend recently paid was RM 60 cent per share. A constant growth of 6% in earnings and dividends is expected for the foreseeable future. Retained earnings available for capital investment are RM 3 million. The corporate tax rate is 26%. So let's we see the requirement. The requirement A is calculate the after tax cost of debt. Second, the cost of preferred stock, and third, the cost of retained earnings, and lastly, the cost of new common stock. And B, what is the maximum capital expenditure if only retained earnings are used for financing? C, determine the weighted average cost of capital. This is this question, so we will go for the answer, of course. For topolobas yang berhad, the first step that we should do is we must extract the information. As you can see, for bond, coupon rate is 11%, maturity 1100, coupon payment RM 121, and is here, which is 10 years. Net market price RM 1018 and 50 cent. Tax rate is 26%. First, we find market price MP, which is 1050. Find flotation cost FC 3% times RM 10,050, which is come from MP, and we will get 31 ringgit and 50 cent. Coupon payment 11% times RM 1,100, and we got RM 121. Net market price is MP minus FC. RM 1050 minus RM 31 ringgit 50 cent, we will get 1018 and 50 cent. Preferred stock, dividend 9%, par value 100. FC, flotation cost is 4 ringgit and 70 cent. Fixed rate 5%, MP, market price is 95 ringgit. Yes. Find the flotation cost is MP times FC, which is 95 ringgit times 5% equal to 4 ringgit and 75 cent. Common stock MP RM 7 ringgit, G 6 ringgit, DO is last year 60 cent, FC 28 cent, and D1 is current year, which is RM 636 cent. So find the FC percent time MP, which is 0.04 times 7, we will get 0.28. Find D1, DO plus 1 plus G, which means that DO will times with 1 plus G, we will get 0.636. That is how we get all this.
I'm Nafis. Okay, Topa. We continue for step 2. In step 2, we must calculate the value of bond VB. The formula is coupon rate, bracket PVIFA, interest, and N bracket plus maturity value MV, PVIF, interest, and net, and the N for the year. Okay, for CP we get RM 121, PVIFA For interest, we get 13%. At the end, we get 10 years plus the maturity value. Maturity value is 1,100 ringgit. PVIF 13% and 10 years. Okay. There is two way to calculate the PVIFA and PVIF. For the manual calculation, I will teach you how to calculate. First, this is the formula. Formula is 1 minus bracket plus 1 plus R. R is rate. Bracket and the power of negative n divide by R, my friend. Okay, my friend. We will get and we put the amount of the symbol, and we get 1 minus bracket 1 plus 0.13 bracket the power of negative 10 divide by 0.13. We get the answer 0.7044541 divide by 0.13, and we get the answer 5.4624. Okay. Another way to calculate PVIFA, we must open a Mozilla box or Google. Mana tak kisah. Okay, we type Google mini web. We type a website that mini web tools, and we click the online to end calculator, and then get the website. Okay, we click we look at categories, the advanced categories. For this, we must click for financial calculator. Okay. Then we hold the control and push the key for F and find the PVIFA. There is PVIFA calculator. We click there. Okay. So hard to do. Okay, my friend, PVIFA calculator. We put the amount for the interest rate. In this question, the interest rate is what? 13, my friend. Yes, 13. Okay, the number of years is 10, my friend. Yes, it's fine. Then we calculate the PVIFA. There's the result. This is much faster than manual. That's right. Okay, my friend. Okay, well, we continue with our answer. Okay, let we calculate for the PVIF manual calculation. There is the formula provide to find the PVIF. 1 divide by 1 minus bracket 1 plus R bracket the power of negative 10. We put the amount for this formula. 1 divide by negative bracket 1 plus 0.13 bracket the power of 10. So we get 1 divided by 3.39457, and we get the answer 0.29459. Okay, the PVIFA we can also calculate in PVIF calculation online that I teach you tadi. Okay, we go to the financial calculator and we type PVIF. So click the PVIF calculator, not PVIFA. Enter, and same like sorry. We put the amount the rate for the period is 13%. The number of period is 10 years. Okay, then we calculate. So the result is same amount. So let's continue. Okay. We must assume two options for the bond. First, the current rate is 11%. We must assume over 2 from the actual rate. So we assume the assume is 13%. Okay, let's calculate. Okay, for the assume of 30% rate, RM 121 TBIFA 13% 10 year plus the maturity value RM 1100 TBIFA 13% 10 years. Get RM 121 times 5.42624 plus RM 101,000 1000 times 0.29459. We will get RM 656.57504 plus 324.049, and the answer we get is for VB is RM 980.62404. We must take 3 decimal only. Okay. The next, for the step 3, the formula is same with the step 2. Okay, formula same. The formula is same. 100. The formula is same, but we might assume the current rate is below 2% from the current rate, the actual rate. Okay, the current rate is 11, so we assume below 2 is 9%. So we just calculate same like in step 2. Just put the amount, change the the interest from 13 in step 2. We change to 9. Okay, let's we calculate together. Okay, my friend, RM 121 PVIFA if the interest we put 9%, and the year we put the same years, 10 years, plus RM 1100 PVIF, sorry, mistake, not PVIF but PVIF, my friend, 9% and 10 years. Okay, we put the amount in that formula for the so there is RM 121 times 6, the PVIFA for 9% and 10 years is 6.41767 times the maturity value is RM 1100, and the for the PVIF 9% and 10 years we get 0.42241. Okay, we get answer RM 776.538 plus RM 464.651. We get the answer for the interest 9% below 2% from the actual rate is 1241.189. ringgit. Okay, that's all from me, Nafis. My friend, our teammate, my friend, Qayyum will continue for the next step. Okay, thank you, my friend, for focus on my presentation. Okay, we meet another day. So long, my friend. Assalamualaikum warahmatullahi wabarakatuh.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Abdul Qayyum bin Muhammad Zahari. Okay, I would like to continue step 4, which is how to calculate the interpolation formula. So this is the formula. K equal to 8%. 8% we get from the 13%, which is our first assumption. So plus bracket A, we get how Mr. Nafis found out from the previous step, and minus with B, the cost of bond, and divide by A minus C, like bracket times with C percents, which is our second assumptions of percents we choose, and minus with A. Alright, so we put the amount into the formula. So this is 13%, we get it from first assumptions, plus with the 980.62 we get from here, minus with the B we get from cost of bond, divide by 980 we get from the A amount, minus with the C amount, which is this. Alright, bracket times with the C percents here. Alright, and 13%. Okay, this is how we get it. 13% plus 0.14537 times negative 4%. So this is the amount, which is the interpolation formula, how to get the interpolations. Alright, the next step here, how to calculate the cost of bond, or we call it cost of debt. Step 5, this is the formula. K bracket T minus tax rate. Alright, this the 12.4185 we get from here, the interpolations. Alright, T1 minus with the tax rate have given from these questions. So the cost of bond is 0.0918969. Alright, now we go to the second question, the cost of preferred stock. So this is the formula. KPS equal to dividend divided by MP minus FC. Okay, this first we have to calculate the dividends of preferred shares. Okay, 9% have given by the questions. Right, so this is the 9% of preferred stocks. Alright, so times with 100 we get 9 ringgit. So we put the amount into the formula. So dividend 9 ringgit, and MP is 95 minus with the flotation cost RM 4 ringgit 75%. So we get the answers. Alright, the next is the how to calculate the common stock. This is the formula. KCS common stock equal to D1 divided by MP minus FC plus growth. Alright, D1 we get it from the 0.636 divided by MP 7 minus RM 0.28 plus 0.06. So the information have given into the questions. Alright, this is the flotation cost 4%. Then the market is 7 ringgit. Dividend paid is 60 cents, and the growth is 6 cents. Alright, so we get the answers. So the last is determine the weighted average cost of capital. This is the table. We have first source of finance, weight, cost of capital, and the calculation. So we first is a bond, preferred share, common stock. We put how I get the weight is based on questions I've given. The type of securities 20, 15, and so we put under weighted, so over 100. So the cost of capital, this is the previous step how to calculate the each finance source of finance. So this is the amounts. So for the A times B, we put the 0.20, which is the weighted times with the cost of capital. After that, we sum all add up all the amounts, and we get the 13.386. This is the WACC. Just that for me. So I hope you enjoy our team's groups presentation and all discussions. So we end our discussion with Tasbih Kifara and Surah Wal Asr.